Hey everyone, and welcome back to the channel. And today we're diving into a topic that makes most people groan: taxes. But hold on, don't click away, because what if I told you there are perfectly legal ways to keep more of your hard-earned cash away from Uncle Sam's hungry hands? How to legally avoid taxes and sleep great at night. Yeah, you heard me right. Now, quick legal eagle moment. This is financial education, not financial advice. I highly encourage you to chat with your own accountant or tax pro. They're the superheroes in tailored suits. If you don't have one, well, consider this your lucky day for some awesome free info. If this video helps you save even a little bit of money, and I'm confident it will, please do something awesome with it. Treat yourself to that fancy coffee, take your mom out for dinner, help someone else out. My philosophy? That money is way better in your pocket or doing good in your community than just vanishing into the IRS abyss, right? Now, this video is laser-focused for those of you earning under $400,000 a year. Why that number? Well, once you start making over $400K, and especially over $1 million, a whole different playbook of tax strategies opens up. Think fancy trusts, complex deductions, stuff that needs an army of specialists. We're keeping it real and relatable today for the everyday hustlers and go-getters, for incomes under $400,000 a year. And let me be crystal clear, there's no magic wand here, no secret handshake that poofs your tax bill to zero. That kind of voodoo? That's reserved for the mega billionaires with their offshore fortresses and legions of tax attorneys. That's not us, folks. If you're looking for shady, under-the-table, how to go to jail for tax evasion tips, wrong video, my friend. You clicked on how to avoid taxes legally. So we're going to learn how to legally nickel and dime the IRS. And trust me, those nickels and dimes, they add up to some serious cash. Ready to become a tax-saving ninja? Let's go. Section 1. Workplace Wonders. Workplace Wonders. All right, first up, some gold mines often hidden right within your workplace benefits. Don't sleep on these. Tip number 1, Commuter Benefits. Commuter Benefits. Save up to $3,600 a year, tax-free. Seriously, if your job offers this, grab into it. For 2025, you can set aside up to $300 a month pre-tax for your commute. That's $300 that the IRS doesn't even get to see, let alone tax. Do the math. $300 a month is $30,600 a year that you're effectively getting as a tax deduction. Example. Let's say you spend $150 on a monthly train pass and another $100 on parking near the station. That's $250. If you pay that with post-tax money, you've already paid income tax on that $250. But with commuter benefits, that $250 comes out before taxes. If you're in a 22% federal tax bracket, plus state taxes, you could easily be saving $70 to $80 a month just by using this. What it covers. This isn't just for trains and buses. It can cover subways, van pools, ride-sharing like Uber Pool or Lyft Shared. Check your plan specifics. Parking meters, parking garages. It's pretty broad. How to get it. Usually you sign up through your HR department or a benefits portal. It's often a use-it-or-lose-it monthly thing, so estimate your costs accurately. Are you using this? If not, you're literally leaving money on the table. Tip number 2. Retirement plans. 401k, 403b, 401k, 403b. Pay less tax now. Retire rich later. This one's a classic for a reason. Your 401k, if you work for a for-profit company, or your 403b, for certain government or non-profit peeps, is a powerhouse. How it saves you taxes now. Every dollar you contribute from your paycheck to a traditional 401k or 403b reduces your taxable income for the year. Example. You earn $60,000 a year and contribute $5,000 to your 401k. Boom! The IRS only taxes you on $55,000. If you're in that 22% federal bracket, that's $1,100 you just kept away from them right off the bat. The magic of tax-deferred growth. Not only do you save on taxes today, but the money in your 401k grows tax-deferred. That means all the interest, dividends, and capital gains your investments earn, they're not taxed year after year. They just keep compounding, like a beautiful financial snowball rolling downhill, getting bigger and bigger until you retire. Employer match. Free money. Many employers offer a match. They might match 50% of your contributions up to, say, 6% of your salary. If you're not contributing enough to get the full match, you are turning down free money. Don't do that. It's like finding a $100 bill on the street and just walking past it. At the very least, contribute enough to get your full employer match. It's an instant 50% or 100% return on your money. There are other plans like 457B says, simple IRAs, SCPRAs for small businesses and self-employed, but 401ks and 403Bs are the big ones for employees. Section 2. Healthcare hacks. Okay, nobody likes medical expenses, but there are ways to make them less painful on your wallet. Tip number 3. HSA, Health Savings Account. HSA, the triple tax advantage. If you have a high-deductible health plan, HDHP, the HSA is your best friend. Seriously, it's like the VIP of savings accounts. It has a triple tax advantage. Chapter 1. Tax-deductible contributions. Money you put in, up to the annual limit, is tax-deductible. So, just like the 401k, it lowers your taxable income for the year. Cha-ching! 2025 limits. For an individual, it's $3,850. For a family, it's $7,750. If you're 55 or older, you can add an extra $1,000. 2. Tax-free growth. You can often invest the money in your HSA in stocks, bonds, or mutual funds. And guess what? All those earnings and interest grow completely tax-free. 3. Tax-free withdrawals for qualified medical expenses. When you use the money for qualified medical expenses, doctor visits, prescriptions, dental, vision, even things like acupuncture or chiropractors, it comes out completely tax-free. Example, you have a $3,000 medical bill. If you pay it from your regular bank account, you used money that was already taxed. If you pay it from your HSA, you used money that was never taxed on the way in, potentially grew tax-free, and isn't taxed on the way out. It's like getting a discount on all your health care. Pro tip. Many people use their HSA as a stealth retirement account. They pay for current medical expenses out of pocket, if they can afford to, keep their receipts, and let the HSA money grow invested for decades. Then, in retirement, they can reimburse themselves for all those past medical expenses tax-free, or just use it for future healthcare needs. It's incredibly flexible. Tip number 4. FSA, Flexible Spending Account. An FSA is another way to pay for healthcare expenses with pre-tax money. Super useful. You estimate your medical expenses for the year, co-pays, prescriptions, new glasses, etc. And that amount is deducted from your paychecks pre-tax. The catch: use it or lose it. This is the big one. Generally, if you have money left in your FSA at the end of the plan year, you forfeit it. Poof, gone. Oh, some good news. Many employers now offer a grace period, a couple of extra months to spend it, or a small rollover amount, like up to $600 for 2024, rolling into 2025. Check your plan details. When it's good, if you have predictable medical, dental, or vision expenses, an FSA is a no-brainer way to save. If you know you need braces or you have regular prescription costs, load up that FSA. Tip number 5. Dependent Care, FSA. This one is huge for parents or anyone caring for a dependent adult. You can set aside pre-tax money, up to $5,000 per household for 2025, to pay for care expenses so you can work or look for work. What it covers: daycare, preschool, nannies, au pairs, babysitters, yes, even the one for date night if it allows you to work. summer day camps, after-school programs, adult daycare facilities for a dependent parent. Example: if you spend $5,000 a year on daycare and you're in a 22% federal tax bracket, plus state, using a dependent care FSA could save you well over $1,000 in taxes. It's like getting a discount on childcare. Section 3. Investing smarter for tax savings. All right, let's talk about making your investments work harder for you, tax-wise. Tip number 6. Harvest those capital losses. Lost some money in stocks or crypto? I know, it stings. But there's a silver lining. Those losses can be your friends at tax time. How it works. Capital losses can offset capital gains. If you made $5,000 on one stock but lost $3,000 on another, you only pay taxes on the net $2,000 gain. Even better, if your losses exceed your gains, you can deduct up to $3,000 of those net losses against your regular income, like your salary each year. That directly reduces your taxable income. Crypto. Blind spot. For stocks, your broker sends you a Form 1099-B that usually details your losses. It's hard to miss. But with crypto, especially if you're using multiple exchanges or DeFi, you often have to track and report those losses. So many people forget or just don't bother. Don't be that person. If you lost money on Shiba Doodle coin, report it. Those losses can save you real tax dollars. Carry it forward. If you have more than $3,000 in net capital losses, you can carry the rest forward to future years to offset future gains or deduct against future income. Tip number 7. Aim for long-term capital gains. This is a biggie. If you hold on to an investment like a stock or crypto for more than 1 year before selling it at a profit, it's classified as a long-term capital gain. The benefit. Long-term capital gains are taxed at much lower rates than short-term gains, investments held for a year or less, which are taxed like regular income. The long-term rates are typically 0%, 15%, or 20%, depending on your overall taxable income. For many people earning under $400K, you'll fall into the 15% bracket, which is often significantly lower than your ordinary income tax rate. 0% tax? Yes, if your taxable income is below a certain threshold. For 2023, it's around $44,625 for single filers and $89,250 for married filing jointly. Your long-term capital gains can actually be taxed at 0% at the federal level. Imagine selling an investment for a profit and paying no federal tax on it. That's the power of holding long-term. Tip number 8. Scrutinize your 1099-B. Your broker, Robinhood, Fidelity, Charles Schwab, etc., sends you a Form 1099-B summarizing your stock market activity. Usually, it's accurate, but mistakes happen. The most common and costly error: look for missing cost basis information. The cost basis is what you paid for the stock. If this field is blank or shows zeros for a stock you sold, the IRS will assume you got it for free, and your entire sale price will look like pure profit. You'll get taxed way more than you should. Example: you bought a stock for $1,000 and sold it for $200. Your gain is $200. But if the 1099-B shows a cost basis of $0, it looks like you have a $200 gain. Again, my one request: if this video helps you pocket some extra money, do something good with it. Treat yourself, treat someone else, invest it, pay down debt. Just make it count, because you've earned it and you deserve to keep as much of it as legally possible. If you found this helpful, please give this video a huge thumbs up. It really helps the channel. Don't forget to subscribe and hit that notification bell so you don't miss out on more money-saving tips and financial wisdom. Got questions? Have another legal tax tip I missed? Drop it in the comments below. I love hearing from you guys. Thanks so much for watching, and I wish you a very prosperous, tax-efficient, and absolutely fantastic day. Go save some money.